For more on the markets and where he's finding value right now, we want to bring in Ed Cole. He is the head of multi-strategy equities at Man Group. And Ed, I think you basically look at this and say momentum is going to roll on. Why do you get to that?
So I think I'm naturally a contrarian, and I often have to try to restrain that contrarian tendency. I guess I'm acutely aware that the current stance of the Fed, and it all comes back to the Fed, seems to be that they are inclined to cut. You know that, right? That's what's priced. My read on the economy is it's pretty warm. And I think if what the Fed is telling you, and in fact what Christopher Waller told us a couple of weeks ago, is that they're not concerned about the level of the stock market to begin their cutting cycle, if they carry through with those cuts, then I think they're implying that they're happy to start blowing a bubble. And if they're happy to start blowing a bubble, then what we can see from previous periods where bubbly type behavior takes place is that cross-sectional momentum, so, kind of leadership in markets, runs and runs and runs. I looked at some of the really long run numbers. So there's a phenomenal data set that goes back to the 1920s. And that has some data on market leadership. And that's the winners versus the losers. And if you look at how the sort of leadership worked in the dot-com period on a 5-year annualized basis, so smoothing out the kind of near-term volatility, that was running in the mid-teens. At the end of January, that was 0 for 5 years. So, I'm not saying it's going to happen. I guess the point is that if what the Fed continues to imply and continues to guide us towards is that they're happy that the economy is, in a reasonable place, that rates are restrictive. I have questions about whether they really are. I think
you
we all
don't think
do.
Rates are restrictive right now?
Look, I think there's a lot of... I guess there's a liquidity angle and there's a labour market angle, right? So this week's incredibly interesting on the data front. And let's tackle jobs first and then liquidity second. But if you look at where we are on payrolls today, so I think we all understand that January was a bit of a funny number. But smooth it, you end up at about 220,000 non-farm job creation monthly over the last 6 months. That's a lot. That's consistent with unemployment, probably closer to 3 than 3.7 where we are today. So if we carry on at that run rate, we get through the seasonality and we carry on at that run rate in the 200,000 monthly job creation, I think we could find that the labour market looks in that key measure of unemployment like it's tightening again. Which makes for some slightly uncomfortable thinking on the Fed's part at a time when, since December, Powell and Waller and others have been clear that they feel like the bar to hiking has gone up.
Well, would it be a huge shock to you then if Powell were to say something today or tomorrow that indicated that a rate cut's further off than people were thinking?
My guess is I'm no reader of US politics. I think Brits turning up in America and telling you about politics is the last thing you want to hear. So I think there's a political aspect to these testimonies, obviously. As a market participant, I would expect him to be very measured. I mean, he's good at this, and I think he will probably stress data dependency, the success they've had so far in disinflation. Let's not forget, I mean, core PCE is running on a 6-month annualized basis at 2.5. That's pretty good, right? So you've got a bit of push, a bit of pull, you've got a bit of tightness still in the labour market. ISM services yesterday, the employment component was weak. So you've got some signs that things are weakening. You've got jolts today, which may well show continuing loosening in labour. If
you're right, if your thesis is right, you're basically telling people, game on, stick with the winners we've seen to this point?
So I guess I'm considering it seriously as a possibility. I think so let's think about what bubbles are, right? So the first thing to say is, and this plays into the liquidity part, there's definitely some speculative assets in global markets and US markets, particularly today, that suggest liquidity is profound, right? We have a Fed balance sheet that is huge. We have other central bank balance sheets everywhere in the world that are huge. It feels like we're in an abundant liquidity environment, and the price of speculative things like crypto suggests that's back on. And I would say gold is suggesting that perhaps real rates are a bit too low. If you think then about actual bubbles, I mean, today the US market's on mid-20s earnings. It's not expensive. The tech companies, The leaders don't look wildly expensive by any means at all. The thing that probably to me suggests the beginning of sort of true exuberance is when you look at the long-term earnings growth expectations for the tech sector. So there's this brilliant measure that you can see for consensus earnings expectations, which looks 3 to 5 years out, right? It shows you 3 to 5 year annualized growth in earnings expectations. Today, for the US IT sector, that's running at 25% annualized growth. It's only ever been higher in the dot-com period.
Wow.
And that's the beginning of basically the analysts starting to say there's this thing going on that is so all-encompassing, we're going to see unbelievable growth for like the medium term.